I mean, I think earnings are going to be very good. We're looking for 20% earnings growth year over year. Roughly a third of that is coming from the top line, another third from margins growing in excess of the top line, and then a third from the tax cut benefits. So it'll be very robust earnings. What will matter more will be the outlook for the second half. There are a couple of headwinds beginning to emerge that I think companies will be asked about on the calls. One is trade, of course. So are the proposed tariffs going to have any impact on their business? And secondly, I think FX, currency, and particularly the strong dollar for multinational companies could start to become a headwind. Year over year, not a headwind, but versus where we were at the beginning of the year and where guidance was set at the beginning of the year, starting to become a headwind. We saw that from Oracle last month.
Michael, 2794, that's where the S&P sits as I ask you this question. 2,800 has been this level we just cannot get back above. What breaks us through that resistance?
Well, I think it's the fact that when you look at this quarter's earnings, again, you're going to have more than half of it being, or roughly half of it being driven by top line growth. And if you want to drive your stock higher, how to do it is with earnings growth. I think one thing that you can put a significant amount of confidence in is in the strength that we're seeing in the market today, even in what is likely a blackout period for a lot of companies that they can't be buying back their stock in front of earnings announcements.
Michael, let me ask you about two of your areas of overweight. One is financials, and I don't know whether it's an overweight, but it's a position that you put on last year. That is energy, and it must have worked out pretty well, at least so far. Why do you like these two now and into the future?
Yeah, so financials have been a long-term overweight for us, and I think if you look at that space, there continues to be a lot of value in the names. Some of the names that we like in there, Discover Financial, trading at less than 10 times earnings. Goldman's another name. You look at that stock today, 1.2 times tangible book, 9 times earnings. They should start lapping some of these FIC issues that they've been having, and they haven't bought back a share of stock in the second quarter, so we think that has a nice setup. When you look at the energy space, I mean, you've had material underperformance of the actual stocks versus the commodity rebound, yet you've seen management teams be a lot more shareholder friendly and have very strong capital return profiles. As we go forward, I think there's also a great long-term trade as you've seen tremendous underinvestment, so oil prices should continue to work higher.
Michael, your largest position is Alphabet, so you're still making a big bet on FANG and these high-growth tech stocks.
Yeah, I am. So, you know, when you look at names like Facebook, Amazon, Google, those are names that we all like. Google's by far our biggest position in the portfolio. You've got a company that continues to destroy the law of large numbers in terms of their denominator, and I think they're poised to see some operating margin expansion going forward as you see things like YouTube start to ramp towards $25 billion of revenue. The one name in that space that we don't own is Netflix. I just have a really hard time getting the valuation to work there. I mean, if you ramp that company to, say, 200 million subscribers where the market cap is, you're talking about $900 a subscriber. You know, if you do the math on that, that's about 70 months of revenue based on the highest subscription price that they have, and I just can't make it work.
Eddie, I understand that you're looking at things a little differently. You're not so into tech right now. You're looking more at value, and utilities is something that you like. They had a good day yesterday, not so much today, though.
That's right. I mean, from day to day, they're trading with interest rates more than anything else these days. But what's interesting is if you look at the market performance since the market peak in January 26th, at least as of a couple days ago when I last checked, the best performing sector was in fact not technology. Tech was third. The best two sectors were utilities and REITs, real estate investment trusts. So some of the dividend stocks are beginning to play catch up. I also think some of the more cyclical value parts of the market are starting to look interesting. We've been underweight financials in our portfolios for some time. We're starting to nibble at some of the financial names as they've underperformed recently. I also think industrials, every day that trade is in the headlines and takes the industrial stocks down, they've been underperformers this year. I don't think trade war is in our future. I think these companies are well managed. They're good. They have strong intellectual property. They're increasingly more like technology companies in the way they run their businesses. And so I think industrials are an area that one can buy on weakness as well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.